Hello viewers, welcome to my channel. I'm Hasham Ali Khan. Last three videos I have explained you in detail regarding the topic financial management. The first video on this introduction, I've explained you the meaning of the term financial management and then what the main factor to be considered in financial management, risk and return. What is return? What are the types? What is risk? What are the different types of risk? What is the relationship between risk and return? This I've explained in the first video. Second video, I've explained you the financial instruments which are used by the company to raise the funds. That is debentures, preference share, equity share. All these things I've explained in the second video. And in the third video, I've explained you about the cost of capital. What is the importance of cost of capital? And how to compute the cost of capital. That means calculating the specific cost, calculating the overall cost of capital. All these things I have already explained in the previous video. Now in this video, I'm going to start the problems on financial management. Remember, the problems are based on the theory which I have explained. So make a strong foundation of theoretical concepts and then come to the problem. You can easily enjoy learning the problems on financial management. Otherwise, the problems will become just a mechanical way of learning how to solve the problem. A student must know the first of all basic meaning of the terms which are used in financial management. Then you should come down to problem solving. So before starting the problem, I expect my viewers to have a printout of the problems which I have given in the link under my description. Always keep it ready. Take the screenshot of the solutions of the first few problems, then I explain all the points in detail. Now, see the first problem. A security is currently available in the market at rupees 115 each, which has been issued a year ago, rupees 100 each. Calculate the yield. The security was issued 1 year ago, and now currently the value of the security is 115. So what is the yield? Yield means return. Suppose we take the current market price 115 as P1. And the 1 year ago the price was 100 PO. So 1 year before we give the notation as PO and current year notation will give P1. So how to calculate the return? See, simply, very simple, easy problem. Current market price is rupees 115 and last year's market price was 100. We have to find out the yield. The formula for yield is P1 by PO divided by PO into 100. P1 minus PO divided by PO into 100. P1 stands for current market price. Current market price is 115. And PO, last year price, 1 year ago price was 100. Divided by PO, 100. So 115 minus 100 is 15. Divided by 100 into 100, 15%. That means the yield is 15% on this stock. Now, second problem. A security is currently available in the market at rupees 89, whose face value is 100 and the time to maturity is 1 year. Calculate the yield. That means the security will mature after 1 year at face value. The face value of the security is 100 rupees. So presently the value of the security is 89 and after 1 year the holder will get a return of 100 rupees. So what is the yield? That's what it is asking you. So current market price is 89. Face value of that security is 100. We have to find out the yield. Now see here. The current market price of the security is 89. In other words, it can be purchased now for rupees 89. Suppose I am the investor. I am purchasing the security at rupees 89 now. After 1 year, the maturity period will be over. I have to submit, I have to return back this security to the issuer and issuer will pay me 100 rupees. So presently I am paying 89 rupees. After 1 year I am going to get 100 rupees back. So what is the rate of return I am going to get? I am making an investment of 89. making an investment of 89. After 1 year, I am going to get 100 rupees. So what is the rate of return? It will mature in 1 year. On maturity, investors will get back face value, which is rupees 100. After 1 year, I am going to get back 100 rupees. So in such a case, return can be calculated as, so return yield is equal to FV minus MV divided by MV. FV stands for future value. So after 1 year, the future value is 100. So in place of FV 100, MV, current market price. The current market price is 89. So 100 minus 89 divided by MV, 89 into 100. It will come to 12.36%. This is the return I am expecting in 1 year. That's it. Now, third question. Following information is available in respect of dividends. Find out the average return of dividend from the following. The past returns are given. It is ex post returns. So year 2017, 18, 19, 20, 21. 5 years dividend rate is given. So in 17, the dividend rate is 14%. In 2018, 15%, 19, 13%, 20, 16%, and 21, 17%. The past 5 years returns are given and we have to calculate the average, simple average return. Add up all the returns divided by 5. That's it. So year 17 to 21, all the dividend rates are given in the problem. Take the total as summation x, 75. And n is equal to 5 years, 1, 2, 3, 4, 5 years. Now we need the average rate of dividend. Summation x by n. Summation x is 75. 75 by 5, 15% is the rate of return, average rate of return. Next, fourth problem. The return from security X can be taken in different time periods. Time period 2021 year, January, February, March, April, May. 5 months data is given regarding return percentage probability. What would be the average expected return of the security? These are the future returns. That's why probability is given. Probability is given. January month we are expecting 20% return and the probability is 0.1. February 25% is the expected return. Probability is 0.3. March 25% is the expected return. Probability 0.2. April 30% 0.1. May 40% 0.3. What is the average expected return? So to calculate the average expected return, we multiply the expected return with the probability, right? So calculation of expected rate of return. Here month, Jan, February, March, April, May, 5 months. Returns are given in the problem, 20%, 25, 25, 30, 40. These are the rates. Probability is given. For January, 20% is the return, 0.1 is the probability. Similarly, 25 is the return, 0.3 is the probability. The probability always total must be equal to 1, right? Now simply multiply the return with the probability to get expected return. 20 into 0.1 is 2. 25 into 0.3 is 7.5. 25 into 0.2 is 5. 30 into 0.1 is 3. 40 into 0.3 is 12. Take the total of RP 29.5. That's it. The expected return is 29.5% over. So whenever probabilities are given, multiply the return with the probability and then take the total. That is the expected return. That's it. Now, fifth problem. Vinod company's debentures are bought at rupees 100. Its coupon rate is 8% per annum. Coupon rate means the rate of interest applicable on a bond, on a debenture. So here debentures are there, face value of the debenture 100 and the annual coupon rate is 8%. So 100 into 8% is 8 rupees. So every year the investor will get 8 rupees as interest. It is retained for a holding period of 1 year and sold for rupees 110. That means the investor is getting two returns. He is getting capital appreciation and also he is going to get the coupon interest. So evaluate HPR, holding period return. We have to calculate holding period return. So in this holding period return, we are going to get the recurring income and also capital appreciation. In 1 year, 100 rupees into 8%, 8 rupees interest. At the end of the year, he is going to sell the security at 110. Presently, he bought the security at 100. So 10 rupees is the capital appreciation. Suppose if I am the investor, I have invested 100 rupees in purchasing the security. At the end of the year, I can be able to sell the security for 110. And apart from that, I am also going to get 8 rupees as interest. So what is the holding period return? HPR. So here you can see holding period return. HPR is equal to I plus P1 minus PO divided by PO into 100. I stands for interest, coupon interest. That is 8% of 100, 8 rupees. P1 stands for current price or sale price. At the end of the year, it will be sold at rupees 100. To 110, sorry. At the end of the year, it will be sold for 110. PO, base price or purchase price. So at present, the price is 100. HPR is equal to I. I is how much? 8 rupees. P1, at the end of 1 year, 110 rupees. PO, that is purchase price 100. So 110 minus 100 divided by 8. So 8 rupees is the interest, 10 rupees is the capital appreciation. So totally 18 rupees he is going to get of investment of 100. The investor has invested 100 rupees. At the end of the year he is going to get 18 rupees. So percentage of return is 18%. 100 will get cancelled. 18% is the HPR, holding period return for 1 year. That's it. This is the fifth problem. Sixth one. An investor purchases bond in 2011 having a maturity in 2021. So investor purchased in 2011 and this bond is going to mature in 2021. That means 10-year period. At 970, he has purchased the bond at rupees 970. It has a maturity value of 10 years and par value 1000, face value. Par value means face value. It gives an annual return of 90 rupees. So every year the investor is going to get 90 rupees as interest. Calculate current yield and yield to maturity. So we are required to calculate two items, current yield and yield to maturity. What is current yield? The current yield means percentage of annual interest over market price. Remember this. Always keep a notebook beside you and pen. Whenever I say something important, write it down. Then only you can be able to learn. That means you can be able to remember for a long period of time. Always keep a notebook. So current yield means percentage of annual interest over the market price. The formula will be annual interest divided by market price into 100. What is the annual interest? It is given annual return as 90 rupees. The numerator will take 90. Divided by current market price. The current market price of the bond is rupees 970. Presently 970. So 90 divided by 970 into 100. Now you can see here. Current yield. Annual return divided by market price into 100. 90 by 970 into 100. 9.28%. That's it. This is the current yield. Apart from current yield, it is also asking you to calculate the YTM, yield to maturity. What is the average return an investor will get over the maturity period? Maturity period is 10 years. So over a period of 10 years, what is the average return which an investor is getting? That is called yield to maturity. So yield to maturity calculations actually is a lengthy process, but some financial analyst has given a small formula to calculate approximate YTM. The YTM formula is C plus F minus P by N divided by F plus P by 2 into 100, where C stands for coupon interest or annual interest. In our problem, coupon interest is given as 90 rupees every year. The bondholder is getting 90 rupees. So C is equal to coupon interest 90. F stands for future value. That means at the end of 10 years, the investor will get back the face value. What is the face value of the bond? The face value of the bond is 100 rupees. No, 1000 rupees. Par value of the bond is 1000. So at the end of the 10 years, the investor is going to get face value, par value, that is 1000. So F is equal to maturity value 1000. N is equal to maturity period or period to maturity. So how many years? 10 years. It is given in the problem. So here N is equal to 10 years. Then YTM. P is equal to current market price. The current market price is given in the problem 970. Substitute all the values. C plus F minus P by N divided by F plus P by 2 into 100. So C, coupon interest is 90. Then F is 1000. P is 970 divided by N. N is equal to 10 years. Divided by 1000 plus 970 divided by 2 into 100. So 1000 minus 970 is 30. 30 divided by 10 is 3. So 90 plus 3 divided by 1000 plus 970 divided by 2 is 985 into 100. So 93 by 985 into 100, you'll get 9.44. This is the YTM, yield to maturity. That's it. Next, seventh problem. The estimated return of two investments A and B are given below. So two investments are there, A and B. Calculate expected return and risk for each of the investment. So return on investment A, 540. 3 returns are given. And returns on investment B, 3 returns are given, 133. And the probability are given 0.5, 0.4, 0.1. When probabilities are given, it means the future returns, ex ante returns. So we are required to calculate the return and risk of each of the security. First we'll take first security, investment A. Calculation of expected return and risk, investment A. So these are the columns we require. First column is return. The return for security A is given 540. So I have taken 540. Probabilities are given 0.5, 0.4, 0.1. 0.5, 0.4, 0.1. These two columns are given in the problem. Now I want to calculate expected return. Multiply the return with the probability to get expected return. 5 into 0.5, 2.5. 4 into 0.4, 1.6. 0 into 0.1 is 0. Now take the total of ER. 2.5 plus 1.6, you'll get 4.1. So 4.1 is the expected return for security A. So two things it is asking. Expected return and risk. So up to ER, we have calculated expected return. Now we need risk. Risk is measured in terms of probability, in terms of standard deviation. Risk is measured in terms of standard deviation. So how to calculate the risk? Now remember the columns we require. After ER, make D column. D stands for deviations. Deviation of return from expected return. R minus ER. ER already we got 4.1. ER we got 4.1. So R minus 4.1. How much is the R here? 5. 5 minus 4.1 is 0.9. 4 minus 4.1 is minus 0.1. 0 minus 4.1 is minus 4.1. These are the D values, deviation. Now square D values. So 2.5, 0.9, sorry. 0.9 is the D value. Now square 0.9 into 0.9, you will get 0.81. उसी तरह 0.1 into 0.1, you will get 0.01. Similarly, minus 0.41. When you square minus, it will become plus. Minus into minus will become plus. So 4.1 into 4.1, you will get 16.81. What you have calculated? D square. Now multiply P into D square. P stands for probability. So probability into D square, you will get PD square. P is 0.5. D square is 0.81. So 0.5 into 0.81, you will get 0.405. Similarly, second probability is 0.4. 0.4 into 0.01, you will get 0.004. Last one, 0.1 into 16.81, 1.681. Multiply PD square. Now add the total of PD square. The total of PD square is 2.09. 2.09 is the summation PD square. Now formula for standard deviation is summation PD square under root. Summation PD square under root. That is 2.09 under root. So after root you are getting 1.45%. That's all. This is the first problem in which we have calculated the expected return and standard deviation. The first three columns we got expected return. Then for standard deviation, that is risk, we need D value, D square value, PD square. That's all. Totally 6 columns. So we have completed investment A. Similarly, we have to do the calculations for investment B. The returns for investment B are 1, 3, 3 given in the problem. Probabilities are given 0.5, 0.4, 0.1. Same probability whatever is given in the problem. Multiply R into P. We'll get ER, expected return. So 1 into 0.5 is 0.5. 3 into 0.4, 1.2. 3 into 0.1, 0.3. Take the total, you are getting 2. So expected return of security B is 2%. One answer completed. Now we need the risk. Risk is measured in terms of standard deviation. And standard deviation formula is summation PD square. So first we calculate D. D stands for deviations. R minus ER. ER we got 2. So R minus 2. 1 minus 2, you will get minus 1. 3 minus 2, you will get 1. 3 minus 2, you will get 1. These are the D values. Now square it. 1 ones are 1, 1 ones are 1, 1 into 1, 1. When you square 1, again you will get 1. So we got D square. Now multiply PD square. 0.5 into 1 is 0.5. 0.4 into 1 is 0.4. 0.1 into 1 is 0.1. Add up, we will get 1. So summation PD square is 1. Standard deviation is under root summation PD square. So under root 1 is 1 again. That's all. The risk is 1%. So we have calculated the expected return and risk of security A and security B. That's all. So this is the completion of 7th problem. Now see the 8th one. The following information is available in respect of the estimated return from 5 securities under different investments. So 5 securities are there: A, B, C, D, E. Each security expected return is given 12%, 9%, 15%, 18%, 14%. And amount. How much amount is invested? So investments are 150, 250, 300, 100, 200 in thousands of rupees. Ignoring thousands, 3 zeros, we got this one. Find out the expected return. So how to find out the expected? First we find out the proportion of funds, that is weight. So security A, B, C, D, E. Returns are given in the problem: 12%, 9%, 15%, 18, 14%. Now amount of investment. The amount of investment in A security is 150, B security 250, C 300, 100, 200. These are the investment made in each security. So total investment, if you add up all, you will get 1000. 1000 is the total investment in all the securities. Now we calculate weight. W stands for weight. How to calculate weight? Investment divided by total investment. How much is the investment here? 150. Total investment 1000. So 150 divided by 1000, you will get 0.15. 0.15. Similarly here 250. 250 divided by 1000, you will get 0.25. Then 300 divided by 1000, you will get 0.30. Then 100 divided by 1000, 0.10. Last one 200 divided by 1000, 0.20. So we have calculated the weight. Individual investment divided by total investment. We got the weight. Now multiply the return with the weight. 12 into 0.15 is 1.8. 9 into 0.25 is 2.25. 15 into 0.3, 4.5. 18 into 0.1, 1.8. 14 into 0.2, 2.8. Multiply the weight with the return. We got the expected return. Take the total of the expected return, 13.5. So the expected return of the portfolio, which consists of 5 securities, is 13.15%. So totally 8 problems I have explained in this video. This is the first video on problems on FM. I have explained each and every point in detail. Watch the video not once, twice, thrice to get the complete command on this topic of financial management. I wish all the best for you, for your preparation and for your exams. Inshallah, we will continue the next problem in the next video.